Man, the world is on fire, and look at this market. Look at this market. It's finding some positivity and going to the upside. Wow, that's crazy. Yesterday we had this nice pop, and then we had this fade. This is a very popular trade to do in a lot of arenas, a lot of day trading. The pop and fade. You find a level, and then as soon as it hits that level, you short it, and then boom, you make all this money right here on the short. I don't know if people are doing that today. I gotta check out some traders. I'm not a big pop and fade person. I'm pretty bullish most of the time. But yeah, this world is crazy. The world is on fire. We got Biden in Israel as rockets are going overhead. We have embassies on fire in Jordan, and there's a couple other reports unconfirmed in other countries. And we don't have a Speaker of the House, which is third in line for the presidency, which is kind of concerning. And then we have I usually don't get into politics, but this is crazy. This will affect the stock market. There's a resolution on the floor. Um, I believe it's on the House saying that authorize military action if X, Y, and Z happens, which is pretty scary as well. But like I said, the stock market is forward looking. A lot of these catastrophes don't affect it because that's we're not looking at today. We're looking at 6 months from now. We're looking at earnings, stuff like that. Um, so in all this craziness, I wanted to show you something extremely crazy. Now, if you guys remember, CCL, Carnival Cruise Lines, got crushed the last couple days. It's all the way down to 12. Here, bounced off 12, which I have a video showing that 12 is a significant level. But look at this march down from 19, 20-ish, all the way down to 12. These two levels are very significant, and it went from one to the other extremely fast. Now, what I did around 16 is I sold my shares. I sold my shares because as it hit 16, I saw this right here. And if it breaks below this level, we're in trouble. So I sold my shares. I bought a call against my 16 call because I had sold a call at 16 for CCL and it was in the money. So I had to protect the covered call. So I bought a call, turned it into a poor man's covered call or a synthetic covered call. And now let's see how it's doing. So I got this 16 call here, sold it for 142. It's currently trading at 27. That's a profit of 114 if I took that right now. Now, this is for January, so this still has 3 months left. But look at the synthetic cover call that I bought. This call, I believe I bought it for 400. Currently trading at, no, I bought it for 300, currently trading at about 119, which if I sold it today, I would lose 195. But I don't have to sell it today. I don't have to because it's all the way till April. That's 6 more months. That's why you buy it way in the money, way out, way further than this call. That's so I can buy back this call against buy back this call and sell another call against this call. Now, why would I do that? Why wouldn't I just close out the whole trade and get out of it? Well, that's you have to manage it because this would be a losing trade. I'd make 114 here, but I'd lose 195 here. Why would I sell when I got 6 months left on this one to get back my money? Well, you would do that if the stock is horrible stock. I think this is an overreaction due to the release from United Airlines saying they're getting crushed due to this war. And if you look here, the consensus is 18, which is a 50% upside. 50% upside. So even the low is at my covered call. So at the very least, I'd get my money back for my call. And if you look here, they're all buys with $20 as the price target. So yeah, of course I want to keep this. I want the 6 months in order to get my money back on that, and that would be a fantastic trade because I'm making hundreds of dollars on $300. That's a fantastic use of capital. So what am I going to do with this is the question. Well, it's starting to pop. So I could close this out for $27, buy it back for $27, and then just have the call. Or I can roll this 16. Let's go down to 15. And let's do it for January, same time frame. It'll give me a credit of $15 because I'm moving this down a dollar, and it's still way below my covered call is at 14. So that still gives me a few months to get back to this 15 level, and then I can I have this 14 covered call here. The other thing is, what's scary is if this 15 triggers, then I exercise this 14 call, and then I'm out the 300, but then I make the profit between 14 and 15. Do I want to do that? Actually, that's not enough credit, I don't think. I don't want, on second thought, I don't want to roll that because it's down. So I just want to buy it back, and maybe I can get more than 27 on the pop. So let me buy back. Let me buy back this for 28. Get out of that cover call completely. And now all I'm going to do is wait for a pop. Wait for a pop to get back my money on this call. Or if we got another pop, I could sell another cover call against this 14, but I don't want it at that 15 level because that's too close to my strike. What I want to do is, let's see where the level is at. I want to go back over this 16. So ideally, I want to sell 16 or higher on my seller cover call at 16 or more. That gives me a little more cushion for my synthetic covered call. So yeah, that's the trade. There are trades when the world is on fire. Don't assume that the market is down and there's nothing to trade, because there always is opportunity. I just made $120 some dollars profit, and I'm waiting for this stock to pop, which all the analysts say it will, and then I'll make another. I'll make back 400, and that'll be a huge profit. Excellent use of capital.